Hi everybody. In this video, we'll continue the exercise we began in the previous two videos by writing the adjusting journal entries required at the end of the accounting period for this company. Please note that your Excel workbook has two worksheets. The first worksheet was the Journal Entry or JE worksheet tab, and that's the one we just finished in the last two videos. The next tab is the Adjusting Journal Entry tab, AJE. That's the one that we need to work on in this video. So please click on the AJE worksheet tab so we can begin writing the necessary adjusting journal entries for this company. On this worksheet, you're given the same chart of accounts that you had in the prior worksheet and the following instructions. This company does not make monthly journal entries. It is now December 31st, 20X1, and the company must make all adjusting entries required for the year ended December 31st, 20X1. We're going to follow the same procedure and skip writing the actual account titles and write the account numbers to be debited and credited instead. So the first journal entry says prepare an adjusting entry with respect to the rent that was prepaid on August 1st, 20X1. Well, it's December 31st, 20X1 now, and what we need to do is look at the actual journal entry and transaction on August 1st. So I'm going to click on the JE tab, Journal Entry tab, and take a look at that transaction and the journal entry we wrote for it. On August 1st, the business wrote a check for $7,200 for 12 months office rent. So now we have the information we need to calculate how much rent expense we have incurred from August 1st to December 31st, 20X1. We paid $7,200 for 12 months of rent. Therefore, $7,200 divided by 12 equals $600 per month rent expense. But there have been 5 months since August 1st. All of August, September, October, November, and December. That's 5 months. So $600 per month times 5 months equals rent expense of $3,000. We need to debit the rent expense and credit the prepaid rent. You don't credit cash. You've already paid for this rent. You paid 12 months worth of rent, $7,200 on August 1st. So we're going to reduce that prepaid asset and we're going to debit the expense. So go ahead and write that journal entry, adjusting journal entry, then start the video again and check your work. Debit rent expense, account 655 for $3,000, and credit prepaid rent, account 128 for $3,000. In the next journal entry, we need to record an adjusting journal entry to record depreciation on the equipment that was purchased on September 1st. Let's go back to the journal entries and see what equipment and what information we have about depreciating that equipment on September 1st. On September 1st, we purchased supplies. Well, we don't depreciate supplies, so we ignore that completely for depreciation purposes. But we also purchased $6,300 in equipment, and it says the company uses the straight line depreciation method and expects the equipment to have a useful life of 7 years. Now we have the information we need to calculate depreciation. There are 84 months in a 7-year period. That's calculated as 7 years times 12 months per year, 84 months. Straight line depreciation is cost minus salvage value. The problem is silent with respect to salvage value, so we can assume salvage value is 0. So cost of $6,300 minus 0 salvage value divided by 84 months equals $75 depreciation expense per month times the 4 months that have lapsed since we acquired the equipment and put it in service on September 1st. All of September, October, November, December. That equals $300 of depreciation expense. Go ahead and write the adjusting journal entry. Then start the video again to check your work. Depreciation expense is account 605, and accumulated depreciation is account 168. Debit account 605 for $300 and credit account 168 for $300. Okay, we've been working pretty hard, so I think it would be a good time to take a bonus break. I will award 5 bonus points to the first 35 students who send me a picture of a pretty goldfish by 11:59 p.m. on the due date of exam number 1. Now, there are more than 35 students in this class, so you don't want to go telling everybody because they'll submit the picture before you do, and you won't get the bonus points. So be quiet, keep it hush-hush. Send me a pretty picture on canvas, by the way, of a goldfish, and before 11:59 on the due date of the exam number 1, and I will give you 5 bonus points. Okay, let's continue. An inventory of supplies taken on December 31st, 20X1 shows that $200 of supplies were still on hand. I'll give you a hint. There were no supplies on hand at the beginning of 20X1, and no supplies were purchased during the year except those that were purchased on September 1st. Flipping back to September 1st transaction, it says that we purchased supplies in the amount of $1,500. So go ahead and calculate your supplies expense and then record the journal entry for this adjusting journal entry. Then start the video again to check your work. Well, we purchased $1,500 of supplies, and $200 were on hand at the end of the year. That means that $200 worth of supplies were not used. $1,500 minus $200 equals $1,300 of supplies used during the year. And in adjusting the asset supplies, the expense is the amount of supplies used. So we're going to debit supplies expense and credit supplies for $1,300. Debit account 640, supplies expense for $1,300, and credit account 126, supplies for $1,300. Number 4, prepare an adjusting journal entry with respect to the note dated October 1st, 20X1. Remember that interest, whether it's interest income or interest expense, it does not matter. The formula is principal times rate times time. So I want you to take a look at the journal entry that you made in the JE tab for October 1st. Take a look at the interest rate and accrue October, November, and December, 3 months worth of interest on this note. Do the calculation and prepare the journal entry. Then start the video again to check your work. On October 1st, The company borrowed $300,000 from First Bank, and the note requires the entire $300,000 of principal plus 8% simple annual interest to be repaid on October 1st, 20X2. Using the formula principal times rate times time, or PRT, $300,000 of principal times 8% annual interest rate times 3/12, is that annual interest rate is a 12 months worth of interest, and we're going to have only 3 months of using the bank's interest between October 1st through December 31st. So $300,000 times 8% times 3/12 equals $6,000 of interest expense for the year ended 20X1. Debit account 651, interest expense. And we're not paying that. We won't pay it until October of next year. So credit interest payable, account 211. Debit 651, $6,000. Credit 211, $6,000. I want you to go ahead and write the adjusting journal entries for transaction number 5 through number 9. Then start the video again to check your work. Okay, I'm going to give you a chance to check your journal entries, and we're running out of time on this video, so in the next video we will go over the step-by-step calculation and journal entries for transactions 5 through 9. So go ahead and check your work. And if you didn't get something right, that's totally okay. Come back and take a look at the next journal entry to find out why you made the mistake and how to make it right. See you next time.